Hi, this is Randy Finney with Right Side of the Chart, and this is a post FOMC wrap for Wednesday, May 7th, 2025. It is 3:19 p.m. Eastern Time as I'm starting the video. So the Fed meeting and Powell's press conference is out of the way, and market should soon turn and focus on what they want to do going forward. I'm going to start out here. Somebody asked for an update on ES. Those are the S&P 500 futures. Feel free to bump me anytime if you are, futures trader, and you use anything else. You want the small caps, RTY, you want the mid caps, ES, or even SPY, SPY chart. I covered SPY quite a bit in recent videos, but this is the I posted two charts. You can check those out, and in the comment section if you want a screenshot. But these are kind of levels here. They are levels. I'm sorry. And on the 60-minute chart, I have some more what I call micro levels. That's a big one right there. That's that top of the trading range. Remember, I have that on the SPY and QQQ. This is we were locked into a multi-month trading range, which we broke out of here. We broke down below the NASDAQ 100 and S&P 500 trading ranges. That was a powerful sell signal, in my opinion. That was the downside break I was expecting. Talking about this, it took months to happen, and that's it. Usually, like I said back then, and I often do, the bigger the trading range, meaning the longer it lasts for, and the higher from top to bottom, the more powerful the ensuing move. And as I stated back then, typically the direction you break down is the next tradable trend, and that's certainly what you got there. And if you missed it, it was obviously pointed out at the time, you had an opportunity there, a gift, I like to call it, on a back test of that level. So that's still a very, very big level if we happen to get there. And that's comparable to the level I've been giving you on QQQ, that 500, the 500 level on QQQ, that if and when taken out, that starts to change things. We'll be above the 200-day moving averages. We'll be back above that resistance level. And as long as it's, if it's anything more than just a brief stop clearing pop above followed by a reversal, and that's either way, as I like to say and often do say, resistance is resistance until unless taken out. And we have, as I've been saying, the market's been approaching a mountain of overhead supply, which is another name for resistance. A lot of sellers most likely in there. Again, I can't promise anything as far as whether we're going to get rejected there or not. That's my thought, but I can promise you it's good resistance, very solid resistance on a chart, no matter who you are, how you see the charts. When you go to SPY, and this is my busy board, meaning I have a lot of annotations and lines and levels, but that's that trading range there. And again, so the comparable level is you have a couple punches down through here. You can either look at it about, that's closer to what I give you on ES. ES just has different reaction points. When I turn off all the lines here, you can see if I put a line there, it's about 575 on SPY. So that's the magic number. Probably the biggest level, and I'm going to move that up just a hair. Again, roughly 575. Make it big and yellow or whatever we can do. And that's it. And it's also, that aligns again with the top of the bounce target zone on SPY. Now, what I wanted to cover, there's some new stuff in this video. We're just going to look at the sectors of the S&P 500. And so again, this is a busy board. If I could clean it up, let me just turn off all the lines. I'll hand draw it in for you. So I've stated recently, repeatedly, to my preference to scale back into those longer term swing and trend shorts, which I covered recently back here, stating the likelihood for a bounce and the RR favoring the long side. And been positioning for the next leg down in the longer term accounts as well as in the trading account, and giving you a range there. So if that happens, what might be the catalyst? Well, this uptrend line here. On the daily chart, you can draw nice clean uptrend lines off the lows. I'm talking the lows from April 7th right there. And this is how it looks on SPY. I would encourage you, if you see things the way I do, or you just want some other levels in addition to your own, draw those uptrend lines. You have to exclude that little wick right there, and that's fine. Trend line drawing, I always say, is more of an art than a science. My preference, no matter how I'm drawing, is to catch the most number of both candlestick shadows, those are the skinny parts, and or bodies, that's the fat part. And so that's what that trend line does. It comes in here, starts off at the lows, and goes in, cuts through that, catches the body of both those two candles, comes and gets the tail, or aka shadow of that one, and then the recent candle. So we're right on there right now, and so that could do the trick. Remember, we already hit the split the difference between the 200 simple and exponential. And if we want to run up, if SPY does want to run up to the 200, all the way up to the 200 simple moving average, which is the blue moving average right here. You have the red and the blue together right there, the exponential and simple. Well, guess what? It runs right into dual resistance, both the 200-day and 575. My preference is to be, and as I am, short before there. That's because it's such an obvious level that it's almost too easy. Not to say it can't happen, but when levels are so obvious, what usually happens, especially in this market, I think the sellers are going to start stepping in before there. If they get up there, they might run it and clear the stops. Sometimes you get a perfect, but again, there's too many eyes right now watching the charts, in my opinion. So the likelihood is we've probably seen the highs. That's my guess. And there's why I'm doing the video. I give you the lines right here. Replicate. There's the trend line off. I showed you how to draw it on SPY. QQQ. This is it right here. I'll fatten it up. Let me just hand draw over it with the screen recording software. Off the same low right here. Catch that same body, the fat part of that candle. Catch the bottom of the next candle, the body and the shadow, and it comes into right where we are now. So you have my requisite 3 distinct reactions minimum, or actually 3 already had it there, and we're on it right now. And so these are the levels that I'm going to bet they're going to pop tomorrow. I'll get to the economic report in a second here. Before we do this, as I often say, a index or an ETF or an index or a sector is simply a sum of its parts. Now, in the S&P 500, as the name implies, there's 500 companies in there, the 500 largest in the U.S. We don't have the time to go through 500 individual charts, nor do we need to. What I usually do on the NASDAQ 100 is go through the top, Mag 8, Mag 7, because that has the biggest weighting. About half of the entire returns comes from just those handful of stocks. On the S&P 500, what I like to do from time to time is go through the 11 sectors that make up the S&P 500. And in there, you will note, I always have these, I go through these in order of weighting. Now, from time to time, I'll go in and update it because over time it'll change somewhat. But technology is and has been for a long time the 800-pound gorilla in the room, or the biggest sector by far, without even a close second in the S&P 500. So if you want to know where the stock market is going, you only have to know where tech is going. And again, that's just basically your big tech stocks there. 32%, almost 33% weighting. So 1/3. Remember, there's 11 sectors in the S&P 500, but 1/3 of the returns come from just this one sector, technology. And that's your companies in there, in this subsector are Microsoft, Apple, Nvidia, Broadcom, Oracle, and those companies there. And again, it would have changed since then a little bit, not too much. And there's what I'm doing here again for you is just reiterating that this is what I do. I set all these trend lines. They're nice and clean. They're going to be comparable. It's no surprise. QQQ is a near mirror of XLK. It's so top heavy. The NASDAQ 100 has about 50% of the stocks in there are technology anyway, so you're going to mirror XLK. So there's the trend line. And the way this works for me, there's 11 sectors in the S&P 500. The bottom half don't matter because of the weightings. Again, this is why I talk about this. You have to understand the mathematics of it. Real estate, REITs, basic material, and utility, those are the 3 smallest sectors. Combined, they don't even make up, I think, 10%. So it doesn't matter. They can rip or dip, big time, and they're not going to have a material impact on the S&P 500. So if I get on, I'll touch on them briefly. There's your trend line on XLK, and also a perfect kiss and rejection off the 200 exponential moving average. So you hear my voice, you hear it in these updates lately. And I only say it because I've done this long enough to know most people don't want to short right now. I've heard, rumblings, of new highs. The market's going to go to new highs. It's unstoppable. And again, this is just my style. I would 100 times over rather be wrong and get stopped out here for, sticking with my trading plan, my analysis, my trading style, than to not take a shot, not to be short here. Because this, in a hot trade, this market can reverse on a dime and start moving down so fast that if you wait just a week to decide, oh, you know what, gosh, Randy was right, they really came in and sold the 200-day hard there, or they sold those trend line breaks, well, you may have missed an objective short entry. And if it goes the other way, well, I spent a lot of time in the previous video today telling you that the upside is minimal if stopped out above. Again, every sector is different. This is the trading range on XLK right here, so really about right there. There's your 200 simple moving average, the 200 exponential, but these trend lines I wanted to cover for you. And let me just rifle through the rest of them so you can replicate the trend lines. This is XLF, the financial sector, which is the second largest in the S&P 500. There's again, beautiful uptrend line, nice and clean. PPO is currently back testing the zero line. What does that mean? Well, when the zero line, which is when the 9 EMA, the white line, is above it, you're in a bull market. I'm zoomed in here, it's a little scrunchy, but this was a bear market back. It doesn't look like it because I scrunched the prices, but basically that's it. When you're above it, you're in a bull trend, as you can see all the way up here. Bull trend with little corrections along the way, and when you're below it, you're in a bear trend. And what's nice about that line, it often acts as support or resistance. When you're above it, you buy pullbacks to it on the 9 EMA, the signal line on the PPO. And when you're below it, it often acts as resistance. So we'll see. Either way, I can tell you what I can tell you. I believe definitively we're at a make or break, an important juncture, technical juncture in the market, where if it can power up much more, 5, especially the 6, 7, 8, 9%, it's going to power through some key resistance levels, and it's going to flip some indicators, some of the near-term, intermediate-term indicators from bearish back to bullish. We're going to be back above the moving averages and everything else again. So there's your trend line on XLF, nice and clean, also comes off the lows. That one, as you can see here, perfectly comes in at the bottom of that candle there from you can just replicate on your chart, the 21st. Perfect tag at the bottom of this candle right here, that green candle from the 30th. Perfect tag at the bottom of the candle from yesterday, May 6th. And so far we're on it right now. So we're sitting on, and that's why I'm doing this video, all of them, the indexes, the sectors, all on these uptrend lines right now. And if broken, that's likely to bring in some selling. All right, next, by the way, sorry, XLF, last time I checked, was a 12.4, so half of the weighting that the technology sector had, yet still significant. Again, this is second largest holding. Third largest, again, this may have changed a little since then. They may sometimes XLV and XLF, the financials flip-flop, but about 12% weighting. Healthcare, there's your uptrend line also. Nice, you have my minimum of 1, 2, 3, 4. You have several reactions on it right there. That's healthcare sitting on the trend line. And there's XLY. I didn't draw it because I don't want to force it. It's not as clean. XLY is still well off the highs. And also, as you can see, just recently a perfect kiss and rejection. Nothing big so far, but a perfect kiss and rejection off the 200-day moving average, still below it, the 200 exponential with the 200 simple just above it. XLY is consumer discretionary. That's companies like Amazon, Tesla, Home Depot, Nike. Consumer discretionary, for those not familiar, you have another sector called consumer staples I'll get to in a second. And the way I define it, consumer discretionary is what you want. Consumer staples are what you need. So, Tesla, you don't have to buy that fancy Tesla Model S or whatever it is. You don't have to go to Home Depot and remodel your house and put in new floors and remodel the kitchen and all that. You don't need the latest Nike Air Jordans. Those are things, again, that are used, again, as the name implies, discretionary income. When you have more money than you need, you go out and buy stuff that you want, not that necessarily that you need. I'll get to staples in a second. XLC, beautiful clean up trend line. This is your communication sector. Some big companies in here, namely Meta and Alphabet. I don't know if you can see the back then. Last time I updated it, it was been in 2022. So please note that's going to have changed. But just Meta and Alphabet alone made up 38.5% of this sector ETF right here. And that sector in itself holds about a 9.35% weighting. So you can see as we go down the line here, they matter, but matter less. But collectively now, if you add up XLK, XLF, XLV, XLY, and XLC here, then yeah, that's going to have a big impact on the market. There's your uptrend line right there. So we'll watch that. XLI, these are your industrials, down to about an 8.13% weighting as of last September. Raytheon, Honeywell, UNP, UPS, those kind of companies in there. Beautiful clean up trend line. So that's why I'm doing this video, guys. I wanted to show you. And there's some recent bullish developments here. You had a downtrend line which was broken, so we'll give points there. Now, if that fails, then that's a failed breakout, and unarguably you'll see some longs that took that breakout stop out. That's where their stop should be if that breakout fails. So you want to look for a move down below that trend line. And then on the other side, you have also longs that may be riding this trend up, and or short sellers waiting for a break of this trend line, the longs to stop out. And again, that's why I'm doing this. A lot of these comparable uptrend lines, very well defined. You can set price alerts on them. And I am a betting man by nature. This is what I do for a living. So I'll bet they'll probably break, if not late today, or the late day dump, probably tomorrow when we get the unemployment numbers, but the jobs data, but we'll see. Let me tighten that one up a little. Well, I'll just leave it there. Okay, so you can see it. And then again, so get down the line here. These are consumer staples. Again, the things that you need. I think toilet paper, toothpaste, deodorant, and stuff like that. Certain food products and stuff like that that you have to buy. And those tend to hold up better in a recession. So, and again, you're getting down to the point, was only last time I checked, and back in September, of less than a 6% weighting. So we won't bother with the rest, again, only because they don't matter. They matter if you want to trade them, and if anybody does want to trade in the utilities or energy sector, let me know. Utilities, remember we shorted those back here. We hit my first and second target, came very close to my third target, but it's also at resistance now, and it does have a comparable trend line, which if taken out will head down there. These are typically defensive sectors, but they've been wonky. This AI bubble has turned everything upside down, topsy-turvy. Utilities started going crazy with the expected or implied huge demand for energy because of the extreme energy use to run these AI models. And so the utilities got ahead of themselves, kind of bubble-like too, and it's been kind of just moving sideways for a while. All right, let's see. Let's talk about the economic calendar. It's going to come out tomorrow. Let's go here. Here's your economic calendar. You can access this on right side of the chart, of course. Simply click on resources. It'll take you to this page. Down here, tools of the trade. And there's your economic calendar, something to watch, especially in this market. So today I'll zoom in a little bit. We all know what today was, the FOMC announcement, then Powell's press conference. So then the market will turn its focus back to what's going on in the economy. Powell sat tight, obviously, as expected. We knew he would. And so we'll see what jobless claims comes in at tomorrow. That's a big one, the red star. Consensus is for 232,000 new jobs. Here's your consensus range. There's the prior. Again, this will be kind of a recap. I've been covering this for a while. One of many sites I use. This is just a great site for charts on economic charts, macro trends. And you have all this stuff in here you can play around with. But here's the economy. We're just going to look at a few here. This one, well, let's start with this one. We'll start with housing starts. Okay, and again, you don't have to be an expert market technician or chartist to see what's going on here. So we take a look. Let me change my tool color. Let me change it to black so you can see it against this blue line. These shaded areas, 1, 2, 3, 4, 5, these are recessions. Hopefully you can see that. If not, you need to watch this. There's a little one there. If you blinked, you missed it. But that was a recession right there, brief. And again, you can see what happens prior to recessions. You see housing start to fall right there. There was a nice fall. Then came the recession. You see where the gray lines start. There's the fall. And again, after everything in an expansion, that's good. That's an economic expansion. The business cycle has been spacing out farther and farther. Other than the last financial crisis here, the Fed has, in their infinite wisdom, and I'm being a bit facetious, figured out how to prevent all future recessions ever and end the thing we used to call the business cycle for hundreds of years, in economics, which means the economy goes through phases of expansion, economic booms, and then contractions, including recessions. And so they figured, we'll just keep, every time the stock market starts to go down or the economy weakens, we'll just print a lot of money and take rates to zero and leave them there. And so now we know that they've kind of backed themselves in a corner now. That strategy worked great until you ran out of, till you hit the floor in interest rates, meaning zero on long-term treasury bonds. So, all right, again, back to where I was. So, there's falling, and then came the recession. That was in the 80s. Here's the 90s. Again, everything's good, building a lot of houses, right? All of a sudden, things turn, and then comes a recession. Recession wipes out, purges things out. They're a natural part of the business cycle, completely necessary. And then you have another economic expansion. But then when you see the stock market going to or at all-time highs like it is now, and you see housing starts falling, something's happening. And again, take it for what it's worth. You can sit here and the bobbleheads on TV will talk about this stuff ad nauseum. That's what they do. They just ramble. They give you the fundamental thoughts. Well, why it's different this time. I'm a chart guy. I mean, look at the charts. That was, again, a little blink there. That was that COVID or the Q4 drop? Either way, you can see the cycle has clearly turned, and this has been going down. So somewhere over here in the near future, and they'll declare recessions in hindsight. They always do. You'll have the next recession, and it looks like makes sense to figure it's going to be here very soon. This is the biggest one by far. The things I talk about, that affect the economy and the stock market are consumer sentiment and spending. If you're not familiar, consumer spending accounts for over 2/3, roughly 70% of GDP, gross domestic product. That's pretty much, let's call it the earnings of the United States, EPS, or the earnings, not per share. And, the government can spend, and they will, and they do, and they have been doing that. In fact, they've been spending even when the economy has been on solid footing for a long time. That's something they usually reserved in the past. They reserved stimulus spending during times of exactly that, when you start to go into recession. They've kind of used up all the dry powder. Either way, this is the unemployment rate. And as I've talked about, and for the life of me, I don't understand why I don't see somebody on TV talking about. I've been doing this a long time, and it's simple that the business cycle and the jobs market, again, is the single most important thing, with the consumer accounting for over 2/3 of GDP. Government can spend all they want. They cannot offset a weakness in the consumer. And so obviously it goes without saying, you don't have to have an MBA to understand that when you're out of work, you're not going to spend as much. And here's the job market. So jobless rate, I'm sorry. So when that's falling, there's roughly been a floor around, you can see, for going back as far as this chart can go in the 50s, around 4%. And when it gets that low, that's as low as it gets. And the thing about it, guys, it never, ever stays low. Once it finally inflects, there's zigzags along the way down. And it's not a hard number, but you can see it's in there. It's not a lot of range. You get to that level, and there's always a V, right? You have the zigzags down, and it's always a V. In history, and you're looking at it here, this is as far back as I can go. There has never been a period where you hit this record low unemployment that they keep chiding. The perma bulls that come out on Bubble TV and keep telling you why the stock market's going to go to new highs and why we're not going to have a recession this year because of low unemployment. Well, there it is. It's the record low unemployment, but there's never been a period where it hits that level and stays there for an extended period of time. The bottoms always come as V's once the turn is finally in. Now, the hard part here is recognizing, first of all, you don't want to look for it. This was kind of a quirky market in the 70s. Again, I'm going back 70 plus years. This has been the floor. So you want to look for it about here, right? You can see these turns too. They did matter and they counted. That's actually was the floor back then. We had a period of elevated unemployment. But what you want to do to differentiate is it just kind of takes an eyeball to look at it and see what's the difference of one of these little blips up versus the turn. That was safe to say at this point, and you can eyeball it and see when you start making a series. I can't do it with this drawing tool because I have the little arrowhead, but a series of higher highs and higher lows, you can clearly see it's inflected here, right? That's not just another aberration like these were on the way down, these little counter trend blips. So unemployment is, yes, as the those that are longer term bullish on the economy, not looking for a recession this year and citing the reasons why the stock market's going to go up. Yes, absolutely. We're still at record, at or near historic lows for unemployment, but the turn is in. And again, it's something that unless this time is different, those are dangerous words when you say this time's different. Anything's possible. But to see this and then all of a sudden this again, or even this, very unlikely. Again, just look at it yourself. Just look at these V's. The bottom's in. And this stuff takes time. And it takes time for kind of those that, and guys, I used to be in that industry. I used to work for wirehouses. I used to be a financial advisor, stockbroker. I had to drink the Kool-Aid. And also, if you're in that business, you do have to acknowledge that the stock market goes up most of the time, the vast majority of the time. And it does benefit and has benefited to be bullish over time. If you're going to always be permanently bullish or permanently bearish, you're going to do a lot better being permanently bullish in the long term. But we're not here for that. This is not long term. You don't need, Warren Buffett told you, don't put your money in. And John Bogle said, put all your money in an index fund. If you have a 30-year time horizon, you're going to be do great. And I believe in that too. So if you got money and you're going to put it away for 30 years, you don't need to actively trade. I'm going to show you one more here. There's a bunch out there. You can look at auto and truck sales. Those are right now a little spike up. We saw this surge through the front loading on the tariffs. But the one I like to look at too is U6 right here. There it is, U6 unemployment rate too. And this is even more accurate. So you have three types of unemployment. U3, the official unemployment rate. U5, that includes discouraged workers and other marginally attached workers. And then U6 adds on those workers who are part-time purely for economic reasons. All right, hopefully that makes sense to you. I mean, some people are working part-time. They're working 2 or 3 part-time jobs only because they can't find a full-time job with benefits. So that's no bueno. And that adds into there. So we can look at the rates right here. They are color-coded. U6 is in blue, U5 in orange, and then the official unemployment rate there. And so you can see U6, again, clearly trending up. This is a clear trend, and you can see there comes a point where that trend, when the recession really starts to take grip, begins to accelerate, right? You have the inflection point right here. You're going up, and then it really starts to pick up. That is my prediction, just again, based on analysis of this chart. COVID was a kind of a unique beast because for the first time in the history of the world, the entire world shut down. Countries around the world shut everything down because of the pandemic. So you didn't have, there was a little blip in there, but again, so you can go back as I did on that other chart that went back 70, 80 years and look at that. So there it is, guys. So now I can't promise this will be the one tomorrow that does the trick, but the trend has been moving up, and that's it. So in a nutshell, to summarize this video, there's trend lines to watch. They haven't yet broken. If they break, that would be, in my opinion, an objective level to can increase short exposure for those that have followed doing a similar trading plan to mine, adding back long-term short positions in the bounce target zone. I told you earlier today, or in the last video, I believe, that I don't plan to add anything above that trend line. I'm only going to add now on a breakdown of this or if we were to go above the 200-day, the blue line, the 200 simple, and then we fall back below it. But I'd really like to get below here. I think once we take all those lines out I just showed you on the major sectors, that is a very objective level to add, and possibly, depending on how you want to be positioned, to take it up to a full short position. A full short position does not mean an entire account. Now, you do you, I do me. I'll always be diversified. Full short means just how much you plan to allocate in your portfolio. If you have $100,000 and you want to be 50,000 short, 80,000, do you want to be 20,000 short? Do you want to have no shorts at all? You just want to take your longs out. I told you I went, for the first time in a while, put long, added back stock funds and 401ks, my wife's 401k account. I don't have a 401k because I'm self-employed, so I just trade actively in a SEP, and then scaled out. That's what I did here. So my point is, that might not want to short and might think, you know what, he brings a good point, but we are going up. Yeah, you can stay long, but if that trend line breaks, that might be where you want to stop out and go to cash or reduce some of those long-term positions. And then, of course, I will follow up at the end of the month, like I said I would, to see if we take out some of my longest-term indicators, such as the 20-month exponential moving average on QQQ and SPY. But as I covered a week ago, last week, I believe, many of my intermediate and even some of my longer-term indicators are still clearly on bearish sell signals right now. Just needs the remaining handful of the longest term indicators to flip, and we won't have those until the end of the month because those are based on a monthly time frame. I should say we won't have them to the end of this month at earliest. But again, there's enough evidence to be short and to get even shorter, for lack of a better word, if and when those uptrend lines break. Alrighty, I'll wrap it up here. And if the employment numbers come in rosy tomorrow and the market rallies, well, doesn't change anything. Those levels are still those levels. And I already addressed, if we do go higher, where things start to change and how I would look at it. I would, like I said, wouldn't be keen. You could make a case to short up to 500 on QQQ. I told you my thing is just kind of sit tight now. Got a nice, comfortable short position that I plan to add to swing shorts if and when that line breaks. And then I'll decide, if I even want to go more than that. More than that, the beautiful thing, if you know how to use leverage efficiently and effectively, you can be, and I often am, well over 100 times short the market in my account. But with leverage, especially trading futures, you have a large buying power. But the important thing is then to round it out, be diversified in other asset classes, and often things that are what I call indirect hedges to let's say an index long or short position, which I often do, but that's on and off. Treasuries I'll use at times, and some other things that tend to move inversely to the stock market. But right now I don't have any position in treasury bonds. As I told you the other day, we had that last trade on TLT, closed it out successfully, and sitting and waiting for the next objective move. That was it. We shorted there. Boom, boom. Hit T1, hit T2, bounce as expected. And that's that. So I'll let you know if I re-engage treasuries. But as of now, just sitting out of that one, waiting for the next objective setup. All right, let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.